Hey everyone, welcome back to Weekly Market Outlook. This is for the 16th to the 20th of October 2023. Let's get started with a quick recap of last week. Obviously, the focus from last week was definitely the US inflation number. So just a brief rundown on what's going on. We have the US PPI. This is monthly change was above the consensus of 0.3%. It was 0.5%. The overall year-on-year on the PPI actually picked up a little bit, so that kind of gave a little bit of an indication of the potential CPI numbers. And if we take a look at the CPI numbers, the headline inflation or the CPI year-on-year comes in at 3.7%. This is unchanged from the previous month. And if we take a look at the core inflation, it does come off a little bit from 4.3% to 4.1%. But the rate of change for the CPI was a little bit higher than what the market was expecting. Overall, we have what we would call a more of a sticky inflation coming out from the US. The core inflation does come down a little bit, and that's basically the main goal from the FOMC, which also publishes their FOMC meeting minutes. And from the meeting minutes from September they had a little bit of a doubt in terms of whether or not they should continue hiking interest rate, because the impact onto the economic numbers is kind of real at this point in time. So yeah, I think from the FOMC, it was a little bit more on the dovish side. They are more or less were admitting that the end of the interest rate hikes is actually coming to a close. So the most likely indication from considering the latest CPI number is that the November could still be a potential interest rate hike from the FOMC, but the number has been going down. I think a lot of people were expecting the FOMC to just be done with the interest rate hikes for 2023. In terms of rate cuts, again, the FOMC is not really expecting a lot of interest rate cuts, because considering how sticky the inflation is, they are likely going to keep rates for higher at a longer period of time. Okay, so the past week has also been, if you obviously we don't live under the rocks and we know what's really going on in the Middle East right now. Does that have an impact into the market overall? Yes, it does have a little bit of an impact into the financial markets. I think run to safe haven, we picked that up from gold. We noticed that in terms of the oil market, I've put out reports on the oil market, and there are real concerns that the oil prices could actually go up really high if the situation kind of spread around the other regions as well. But one question that's left to be answered is how the US dollar is actually going to react to it. There are actually two scenarios. Let me just explain this before we go on to what's in store for this week. There are actually two scenarios. One would be where the run to safe haven pushed the US dollar up because everyone is looking to US dollars for safety. The other alternative is actually a rise in bond prices. Previous conflicts in the area kind of suggest that there could actually be a run to safe haven, but not towards the US dollar. It actually is towards the bond market. Right now, the bond market is very volatile, and it might kind of hamper any potential risk sentiment in the market. A lot of people were expecting the October to be more of a bull run, but then the war breaks out, and how is that going to impact the risk sentiment? I think that's the other thing that's still not quite clear, because this current situation that's developing in the Middle East right now, it's still really people were hoping that it didn't get worse, but it's more or less on the edge at this point in time. So yeah, the other thing is if the bond market does pick up, if bond prices in the US continues to go up, that's going to push the yield down, and if that scenario happens, that could actually stop the US dollar from progressing any higher. So just keep that in mind. We're still not quite sure in terms of how the war is going to impact the US dollar itself. Would it impact the US dollar directly? Is it going to push the US dollar up? Or is it going to push the bond market up? If it pushes the bond market up, then the yield is likely going to be capped, and that's going to put a little bit of a stop on the US dollar rise. Okay. All right, so let's take a look at this week. We have the RBA meeting minutes on Tuesday. I don't think there's anything new coming out from that. We have the UK unemployment rate. This is forecasted to remain stable at 4.3%. Previous number was a drop in the unemployment rate. and then we have the US retail sales number, Canadian inflation number. Then we are going to focus on the UK inflation number. So the UK inflation number is expected to come off a little bit from 6.7% to 6.5%. Consensus and forecasts are pretty much the same at 6.5%. So I think we are going to be looking at that inflation to cool off a little bit in the UK. So we're really expecting a little bit of a drop to 6.5% from the UK inflation. And then we have the Japanese inflation number, 3.2% forecast at 3.1%, wrapping up the week with the UK retail sales number. So the data that we are going to be looking at this week mainly focus on the UK side, and at the end of it, we are going to be looking at some Chinese data as well as the Japanese inflation number. Okay, so let's take a look at the dollar index first. So with the dollar index, as we can, as I mentioned before, we were a little bit unsure in terms of how the war is going to impact the US dollar. So you can take a look at the dollar index here. This one here is a little bit flat. So it moved down a little bit towards 106, 105.50, bounces off, and then it's now very close to that 107 range. If going by the momentum and the current trend on the dollar index, there's a high chance that 107 level is actually going to be broken. So there's probably a higher probability that the war could impact the US dollar directly. It could push the US dollar on the back of safe haven concerns. So I think from the technicals that we're looking at, with price bouncing off 105.50, 106, yeah, there's a higher probability right now because we start off the week closer to the 107 range. Momentum is just about to turn. There's a higher probability that 107 is going to be broken. And this is something that we picked up in all the other major currencies as well. For example, on the Aussie USD here, we saw how Aussie USD kind of picked up a little bit last week. You know, it was kind of capped at about 64.25, which is around the 61.8% Fibonacci retracement. It is now back at the zero level. So right now, if we're looking at where the key support is for the Aussie USD, is actually at 63 cents. Because if we take a look at the swing low, throughout the month of October, it's been at around 62.85. It is about 15 pips below 63 cents. So we are going to take a look at 63 cents as the major key level. In terms of the daily close, where are we going to be looking at? We're not going to be looking at a close at below 63 cents. We're actually going to be looking at a close below 62.75. So that's 25 pips below that 63 cents. And if that happens, we have enough momentum, we have enough room for prices to go down a little bit. We're going to be looking at support one on the weekly pivot at about 62.40, 62.50, and then a little bit lower, 62 cents and 61.80 on the Aussie USD. In terms of resistance, we are going to be looking at 63.50 and 63.75 as the major resistance for the Aussie USD. Next up is the EURUSD. For the EURUSD, last week we were talking about a little bit of a pullback. Potentially it's likely going to be capped at 1.0650 to 1.07, and that's basically been the case. Market has been capped at 1.0650 for the EURUSD. Right now it is back closer to 1.05. Now, considering it starts the week closer to 1.05, momentum could turn any given moment. It is still below 1.0650, 1.07. There's a higher probability that this could actually break below 1.05 and progress even lower. Projected target to the downside, we have 1.0450, 1.04, and 1.03. This is in line with support 1, support 2, and support 3 on the weekly pivot as well. Now, the pound USD, we've talked about a potential correction towards 1.23, and that's basically what happened. Price went back to 1.23, got rejected, and we saw the movement back down. It has closed below 1.22. Right now, the immediate support is going to be at 1.21, where the 127.2% Fibonacci retracement is located. And if we take a look at the movement for the drop here, the pullback was back into that 100% level, and it is back at 1.23. So it is a very strong resistance at 1.23. We are going to acknowledge that as the cap for the pound USD right now. In terms of probability, the pound USD is actually leaning towards the downside, and obviously with this week we have a lot of UK numbers, and if those UK numbers miss expectation, if they come in below consensus, we're going to be looking at a very quick drop on the pound USD here. Again, support, immediate support is located at 1.21, Support 1 on the weekly pivot is close to the 1.206, 1.205, and then we have support 2 at that key level 1.2. But in terms of the extremity, if situation gets worse, the US dollar get pushed up, the UK numbers is below the consensus, that could still be the possibility for the pound USD to drop even lower, potentially even to 1.1850. But we are going to be looking at what 1.2 level, because 1.2 is a key psychological number for the pound USD. Now the dollar yen, a little bit different here for the dollar yen. This one here is flat, and we just had the IMF meeting. You know, the Bank of Japan, the Ministry of Finance, kind of to bring up the situation with the weak Japanese yen. They're basically looking for permissions to intervene in the market, and IMF basically just came up with a statement that this was just released, that Japan does not have a reason to intervene. You know, everything in terms of the weak Japanese yen, it doesn't create a critical dysfunction in the financial market, and that itself does not give reason to the intervention from Japan. So in terms of Japan looking for support from other countries for potential intervention, that's pretty much got shut down by the IMF at this point in time. So we are still going to be looking at traders potentially attempting to take the dollar Japanese yen above that 150 level. Overall, technically, this one here is still in an uptrend. We've got a strong support at 148.50. Last week, price bounces off that. 2 weeks ago, price bounces off 148.50. So we're also going to be looking at 148.50 and 148 as a very strong support for the dollar Japanese yen. In terms of resistance, sure, we've got 150, but given the current situation of the interest rate differentials between the FOMC and the Bank of Japan, fundamentally, it's still a weak Japanese yen. In addition, if there's a run towards safe haven, both the dollar and the Japanese yen is going to rise. But considering the current condition, I think there's a lot more power behind the US dollar. So the dollar yen could actually be lifted above 150, but in terms of how extreme it's going to be, it's likely going to be capped in terms of progression, because we got resistance 1, 150.25, resistance 2, closer to 151, resistance 3 at about 152 for the dollar Japanese yen. But overall for this one here, if we see that break above 150, then yeah, we could potentially see that move towards 151 and 152 for the dollar Japanese yen. Dollar Canadian, this one is relatively stable. You know, the past 2 weeks we saw that rejection at 127.2%. Market kind of pulled back down to that 61.8% range, which is closer to 1.3575. We still have 1.35 as a strong support level. Overall condition is still above the Ichimoku cloud. Price is currently opening above the pivot level, and considering if the war does break out and if it gets worse, the US dollar could be the winner there, but at the same time the Canadian could also gain, because we are anticipating at oil prices to pick up a little bit. So the dollar Canadian might not be the best choice, because it could be more of a hedge movement on the dollar Canadian. So progression is likely going to be slow. We could potentially see price pick up a little bit, but it could potentially be capped at 1.37. And in terms of how far it can go, I doubt it would actually go beyond 1.38 at this point in time. The dollar Swiss, we were talking about 90 cents as the price to pull back to. We're looking for buyers to come in at 90 cents. We basically got that in the past 3 days. We have seen buyers come in at 90 cents level. Momentum still points to the downside though, but for now 90 cents hold. And for as long as 90 cents hold, we're still going to be looking at a potential bounce for the dollar Swiss here. Again, if there's no significant daily close, we don't have a close below 1.08975, then we would consider 90 cents level to actually still hold. We're still looking for that bounce from that 90 cents level. In terms of how far it can go, we have a lot of potential target. We've got a pivot at 90.50. We got 91 cents, even closer towards 92 cents on the dollar Swiss. Right. Next up is gold. We talked about gold last week, and definitely do not want to sell gold. I think it was in a face of a little bit of correction, with the situation intensifying over the weekend as well. You can see the sharp rally on gold there. that's really a huge jump. We're talking about near $50 movement on gold there. It has come off a little bit, but if we take a look at where it's come off, it's basically at the Ichimoku cloud. So it's a normal reaction to potential resistance. That's a little bit of an exhaustion, obviously, but it's still going to be above 1900. And 1900 is where the weekly pivot is located. If the situation in the Middle East right now spreads, that's going to leave gold even higher. In terms of resistance, sure, we have 1940 and 1950, but right now, in terms of whether it's actually going to pull back, I wouldn't attempt to trade the pullback on gold, because there's a lot of risk hinging on gold here. There's a potential risk run towards safe haven. Gold could benefit from it. So if you're thinking of trading gold at this point in time, I would just follow with the trend. If the pullback happens at 1900, if price bounces off 1900, then yeah, I would be looking at an opportunity to buy. But I wouldn't be attempting to sell gold at this point in time and attempt to target 1900. There's just a lot of risk involved attempting to short gold at this point in time. Now, last thing is oil. We've put out reports throughout the week last week for oil. There's a lot of reasons. I'm not going to go through the reasons again, but from a technical standpoint, it skidded off the Ichimoku cloud. It created a morning star twice on oil here. In terms of the fundamentals, there's been a little bit of price drop last week from the high supply in the US in terms of oil, but the current situation, again, if it intensifies, if it involves other nations around the region, for example Lebanon, Iran, and Egypt, that could make things worse, and there's a lot of upside risk for oil at this point in time, right? Not just the war, but if we go seasonality, we are coming into winter very, very soon. So, eventually for oil prices going towards the end of the year, seasonally, we typically see a little bit of a higher price for oil. Now, obviously, with the current situation, this is something that we want to focus on, and we much prefer to be long oil at this point in time. And considering that it is still above the Ichimoku cloud, there's no reason to actually attempt short. A very similar situation with gold here. There's a lot of upside risk involved associated with the current conflict. If it intensifies, if its situation worsens, we could actually see a huge quick spike on oil and gold. Okay, so just be mindful of the current situation. We cannot ignore what's going on in the world at this point in time. With that, good luck with your trades, and I'll see you soon.